As this is a pretty long decision, I actually just want to take you through the court's main points in highlights, so you have an idea of how the decision is put together. The court was very diligent in putting in headings and subheadings, which really help with reading the decision. So they start with findings of fact, and they look at Medtronic, and they look at Puerto Rico, and they look at the US, and they look at what class 3 medical devices are, and they explain that these things are difficult to remove and they're highly regulated, etc., etc. Medtronic had two different units, business units that were serviced by MPROC, and they discuss those and discuss how they work, and then they talk about the competitors. There were about 4 or 5, and they discuss what the roles are, and they come up with a pace setter agreement and all the issues. They also explain that the risks are so high that it became too expensive to try and insure against, what happens if you implant these things and things go wrong. So they simply moved to self-insurance, and that again highlights the level of risk that MPROC was carrying. And what the court does note as on the side is that MPROC had the capacity to bear that risk, right? So it also satisfied the Chapter 1(2)(d) requirement on allocating and bearing risk for MPROC. And then it looks at the MPROC agreement, and it talks about the pacesetter agreement, and we get some comparisons of what's going on there. The court talks about product recalls, and the issue is if you have a product recall, it can really destroy your brand and your name. But the other issue is, if there are not a lot of competitors, and if they more or less have product recalls when you do, then you kind of cancel everything else. But the court does address that issue, and they talk about the Swiss supply agreement, explaining that MPROC didn't have enough capacity, and therefore they also used the Medtronic Europe in Switzerland to help with production under the same conditions and with the same support from Medtronic in the US for making those things. And they talk about the notice of deficiency, which is basically assessment of the tax authorities and the case history. And then the court gives its opinion, and it looks at what the parties' positions are. And remember, we're now at the third iteration of this case, and basically they haven't changed a lot. They look at the applicable US statute and regulations, because being a US court, they refer to Section 482 of the IRS regs on transfer pricing, and then they use the US terminology such as cut instead of cup, and CPM instead of cost plus method, and issues like that. And then they talk about, the 8th District Court said we did a couple of things wrong and we need to re-look at that, and we will now look at those things, right? And the first one was whether the pacesetter agreement was a cut. And the court discusses that and says, well, actually, we don't think it's a very good cut, because one, the functions from pacesetter were very different from the functions from MCROP as we just saw. Second, the economic conditions of those two are very different, and here I'm not quite sure I agree with the court, because the court says the economic conditions are very different because the profit potential of MCROP was much higher than what it was for pacesetter. I'm not sure how much the profit potential is an economic condition, but I simply haven't thought that through. And then they looked at the property or services, and clearly MCROP got far more than pacesetter did. I mean, if it got 15 to 1800 patents, whereas pacesetter only got a couple of hundred patents and access to that, right? And the court continues and says, so first of all, the pacesetter agreement is not a very good cut, so we need to see if we can make some adjustments. And then the court decides whether it made appropriate adjustments to the pacesetter agreement, and it kind of comes to the conclusion that it's almost impossible to adjust for all these things. It becomes complicated. And then it asks whether the pacesetter and MPROC circumstances were comparable. I mean, this is just going down the list of comparability factors, and the answer is well, okay, not really. And then a very US specific, but I think also ultimately a TP specific question is whether the pacesetter agreement was created in the ordinary course of a business, because apparently the Section 482 regs say that if the agreement, your comparable agreement, was not made in the ordinary course of business, it may not be a comparable. Now, but the OECD guidelines, to my knowledge, do not say anything along those lines, but it makes sense that you have a condition like that in there. And then they look at the comparability of paysetters agreements contractual terms with MPROCs, and as we saw there were a number of differences. And then they evaluated how the different intangibles affected comparability. The fact that that MPROC got so many access to so many more patterns than paysetter did, and it got all these extra services on top of all the patterns that it got access to. Back office services, all kinds of other services, R&D services, those kind of things, which paysetter not necessarily had access to, and then it looked at whether the cut method, how the cut method compared to the cost plus method, and the allocation of product liability expenses. Was that different? Yes or no? And the court then spent time on what the best method is, and here is something interesting, because they come with something that they refer to as an unspecified method. They say the CPM doesn't work, the cut doesn't work, and we need to find an unspecified method. Now, to be very honest, to me, I think what the court did, it just seems like they came to a residual profit split. And a residual profit split, you first take the routine functions. Maybe that's why the court doesn't want to call it a residual profit split in that regard. And you price that, and then you take the residual profit and you price that. And what the court does here is it gives the introduction of what the best method is. It looks at what the IRS position was, being a very high increase. It looks at Medtronic's position, which says that the increase must not be that high, and then it discusses the unspecified method, which was proposed by Medtronic, and it talks about a three-step process, and we will look, in the analysis, the court decides what works and what doesn't work, and basically step 2 and step 3 does not work from the Medtronic process, and the court adjusts that by making its own step 3. So let us look at the court then discuss the adjusted royalty rate, and it says the same must apply to the Swiss agreement, right? But let us look at this three-step process that was proposed by the court. The court uses the unspecified method proposed by Medtronic, and the first step was to use the cut method. So they say, okay, the paysetter agreement is not the perfect comparable transaction, but we can use some of it, and then we need to make adjustments, right? So under the cut method, they apply the paysetter agreement as a cut for the base royalty due from MPROC to Medtronic, and as we saw, that base royalty the court talks about here is 7%. It doesn't refer to the 3.5%, but it says, okay, for calculating step 1, the 7% retail royalty rate is used because the maximum of 15% retail royalty includes an adjustment for profitability, because the 15% were for important further patterns, right? According to Medtronic, this is unnecessary because step 3 makes an adjustment for profitability, and that's right, because we get, when step 3 we get to the residual profit being split. And then they use the cost plus method, and there's some interesting points here. First of all, it applies the cost plus for MPROC with a modified adjustment for asset intensity. And if I understand the court decision correctly, asset intensity means you take the operating assets, the value thereof, you divide that by the revenue, and then whatever percentage comes out from that, you compare to your comparables and see what their asset intensity is. Now, originally, when applying the CPM, since it is the IRS that applied the CPM, I assume it's their specialist, had 14 comparables, but Medtronic attacked that and said, you know what, these comparables do not make stage 3 medical devices, so you cannot use all of them. And then they ended up with 5 comparables only, and they looked at the asset intensity of these 5 comparables and determined that that was much higher than that for MPROC. So they made a huge adjustment for MPROC upwards, and they did that in the form of a return on assets, And if I understand it correctly, what you say is, well, actually the assets should be much higher. A larger amount of assets leads to a higher depreciation. If you include that in the cost base, the cost plus becomes so much larger, right? And the court does not quite agree with it. It says you overcompensate for this asset, and that you need to reduce that. But we'll leave this as is in your proposal, and we'll simply compensate for that in step 3. And then in step 3, the court says, okay, we now have a residual profit, and we'll split that. 80% go to Medtronic and 20% goes to MPROC. And the court says our adjustments consider that MPROC licenses are valuable and earn higher profits than the licenses covered by the paysetter agreement. That was one reason for making the adjustment. And second, a wholesale royalty rate of 48.8% for both devices significantly bridges the gap between the parties. And this is a bit of an unsatisfactory one, because what the court in effect here says is, if you look at where the taxpayer were, and I think they were around 8% of looking back at Will's blog in the Kluwer tax blog, you look at where the tax authorities were, I think they were at 80%. The 48.8% is something nicely in the middle, and therefore we're doing a bit of horse trading. It almost feels like, right? If we can sit in the middle, then it must be a fair judgment. I'm not sure that's how transfer pricing is supposed to work, but that is what the court decided right here. And then it says the split reflects both the importance of Medtronic's patents, which makes absolute sense because it was the one holding all the patents, and the role played by MPROC. And MPROC played an important role because, as the court decided, it was not easily replaceable. It had highly skilled personnel, and it carried a huge amount of risk for what it was doing in its manufacturing, right? So this came to this decision, the total system profit, so the consolidated profit between Medtronic, the parent, the distributor, Med USA, and MPROC, was 3.3 billion, right? And then in step 1, if you looked at the cut method, let's say $700 million of that gets allocated to Medtronic in the US as a licensor. Then you get to step 2 and A and B, and then basically for us, what is important here is step 2A, where they said, now we're going to apply the modified cost plus method, where we also take into consideration asset intensity, even though it might have been too much in Medtronic's calculations. But we allocate 1.4 billion, which is a significant amount, to MPROC, and unfortunately it doesn't really say what the plus comes down to in percentages. That would be interesting to know that. And then step 2 is simply payments back and forth for components and stuff like that. So step 2B, so we can ignore that. And then they say, okay, let's look at the residual profit, and 80% of that goes to Medtronic, so that is the 1 billion, and 263 million, which is 80% of 20% of that goes to MPROC, and then the total system profit allocated is 2.3 billion to the US and 1 billion to Medtronic. That is the whole decision. I think it's an interesting case. It's a complicated case. One question that remains is the 48% royalty too much? And there's this industry practice, royalty is around 5%, maybe maximum 15%, but never higher than that. And quite frankly, it is in many cases a neighborhood myth. I worked in-house for a group where brands were incredibly important, and what I learned there was quite interesting. And they said, when you look at the royalties that we are asked to pay for using certain brands in our products, what we look at is our contribution margin, which is something between your gross profit and your operating profit, right? It includes a little more of sales-related and production-related costs. And if we get a contribution margin of let's say more than 10%, then we don't care whether we pay 5% or whether we pay 60% for that brand in royalties. We will use it because we make a contribution profit of 10%. However, if we make a contribution profit or margin of less than 10%, we don't care if you ask us a royalty of 1% only. We will simply not pay it because our contribution profit is too small. And I think that makes far more sense to look at things in that way. And in a profit split scenario, the profit split is the ultimate goal. How do you split the profits between parties? And the percentage of royalty is just a means of getting there. It is not the percentage of royalty that is important. It is the result for the profit split. Who gets 50% and who gets 60% or not, and why? And that is what counts, right? And actually, I mean, in one of the I think one of the state aid cases, it was a mistake made by the commission as well, where they tripped over the royalty rate being too high, but the royalty rate was just a mechanism for splitting the profit, and from that point of view, you cannot talk about what the cups are for royalties. So you need to look at how much profits do parties split. If that is the appropriate method, you should not look at how high is the royalty rate. I hope you enjoy this discussion. If you have any questions or comments, please let me know. Otherwise, I look forward to our next talk. Bye for now.